Thanks, Mark. Thanks for attending and listening to us.
Pleasure.
I probably first have to acknowledge and recognise that my business model is a little bit different to most small business brokers out there. I took an attitude or a philosophy when I first set up the business to ensure that there was no conflict in the recommendations that the brokers made, and all of my staff are salaried. They receive a nice healthy salary and they receive bonuses, no commissions, that are not linked to the lender or the loan product that is recommended. It's linked to customer satisfaction, compliance and overall productivity. So I believe I have one of the perfect models that absolutely reduces any potential conflict in that client interaction. It is, of course, quite an expensive model when you're paying salaries, regardless of performance. So from day one, my philosophy has been to continue to invest in the business, invest in the human capital, invest in training brokers up, improving their professionalism, improving our compliance systems to ensure that the service we deliver to our clients is beyond reproach. And the way that we've been able to fund it is generally via the trail payments. The trail payments actually underpin the valuation of our business model, I believe. And it gives me the confidence to continue to throw money at growing a business, marketing, rent, staff, all the IT costs, compliance costs, etc. Hoping that one day someone will recognise that business valuation and that asset valuation and pay me out. So I haven't been working for profit, I've been working for asset valuation, and that's what Trail has delivered. That trail payment today funds 5 admin staff. 3 of those admin staff are in our client care team, and their sole purpose is to address clients' issues and problems and concerns and questions once the loan is settled. I think some of the most valuable components of the activities that they perform are in remediating or being the voice of the client when we need to remediate issues with the banks. The $130 that's overcharged post-settlement, as a business, I go, it's not worth making 4 phone calls to the bank to get that repaid. We fund that to the client. On the bigger issues, and over the last 12 months, we've had 10 clients who we've worked with who have been overcharged interest on their loans. That cumulative additional interest that they were charged amounted to $45,000 through not having offset accounts linked. It took us approximately 50 hours worth of work, so it probably cost us around 10 grand for those borrowers, those mum and dads of Australia, to get the money back from those banks. That without our advocacy, our ability to negotiate with the bank, understand the terminology, to leverage our relationships with the bank, I don't think any of those borrowers would have been able to get those refunds from the lender. As Mark also mentioned, a big part of what we do and our client care team, one of the functions they perform are those top-ups, which are exorbitantly expensive to process, but there is no additional revenue, but it's one of the services we provide our customers that is funded via the current REM model. The list of functions that team performs and that Trail funds is endless. And I'm sure everyone here has stories of ordering valuations for people when they're looking at selling, arranging discharges when they're selling a property, having conversations when their fixed rate expires and it rolls onto a new loan and what their options are, that serves no financial benefit for us, but absolutely serves the clients and the client's best interest. I believe we as brokers are one of the true advocates for borrowers when dealing with the banks. Very few are on their side. We are there leveraging the bank relationships, leveraging the intel we have on each bank and the pricing policies of those lenders to try and negotiate better deals for our clients. Another common function that I think most brokers would probably perform are regular health checks on loans, assessing the bank's, probably the bank's most valuable asset is their back book. People that were previously given a 0.7% discount have been sitting on it for 5 years. And we look at that and we go, we think we can get you a better deal with your existing bank, and we try and renegotiate to get them to a 1% because that's what the current market is delivering. And that of course is a function that the banks despise. They don't like us doing that. But for us, the outcome for our client and the savings that we deliver to the mum and dads of Australia, I think, is incalculable. And one of the main benefits I see, the structure of our REM model delivers to our clients. My fear of a 1.1 flat upfront is the unintended consequences of the behaviours that it will foster amongst the industry. I think it will become very transactional. I think there'll be lower and lower motivation, or less and less motivation for brokers to actually provide that ongoing service for clients. At the end of the day, if the clients aren't being serviced adequately, then our industry is also affected. Our industry is the main source with a main competitive force that ensures banks deliver cheaper loans. We're the main source of cheap finance to regional Australians who aren't serviced by all the big bank branches, who have access to ME, ING, Macquarie Bank. The cheaper lenders out there, the only way most people can get access to them is through brokers. And with a change to the REM model, I don't believe the industry will be as viable or sustainable as it currently is.